Ever wonder why so many investors swear by index funds and ETFs? It's not hype, it's strategy. In this video, we're diving into the power of ETFs, why index funds dominate the market. You'll learn how these low-cost, diversified investments work, why they consistently outperform most active funds, and how to use them to build long-term wealth, even if you're just starting out. Today, we will talk about the power of ETFs, why index funds dominate the market. So before we get started, make sure to hit that like button, also subscribe to my channel. 1. Index funds follow the market instead of trying to beat it. Most active investors try to pick winning stocks. They believe they can find the next breakout company or avoid the next big crash. But index funds do something different. They don't try to beat the market. They simply match it. An index fund is built to track a specific market index, like the S&P 500. That means it holds a small share in all the companies within that index. If the market rises, the fund rises. If the market falls, it falls. This strategy doesn't rely on predictions. It relies on the fact that markets generally go up over time. And for most people, this steady growth is more powerful and reliable than risky guesses. 2. ETFs and index funds offer instant diversification. When you buy a single stock, your money depends entirely on that one company's performance. But with an ETF or index fund, your investment is spread across hundreds or even thousands of companies. That's called diversification. It protects you. If one company struggles, it doesn't hurt your entire portfolio. For example, if you invest in an ETF that tracks the total US stock market, you own pieces of companies in tech, healthcare, finance, energy, and more. That kind of spread reduces risk and helps smooth out the ups and downs. It's a smart and simple way to grow wealth without putting all your eggs in one basket. 3. Index funds beat most professional investors over the long term. You might think professional fund managers with years of experience can easily beat index funds, but research shows that over time, most of them don't. In fact, more than 80% of actively managed funds fail to outperform their benchmark index over a 10-year period. This means regular investors who simply put money into index funds often end up doing better than expensive professionals. The reason is simple. Active managers make trades, try to time the market, and charge high fees. All of those things cut into your returns. Index funds, on the other hand, stay consistent and low cost. And that adds up. 4. ETFs are more flexible and easier to trade than mutual funds. While mutual funds and index funds are often talked about together, ETFs, or exchange-traded funds, have a unique advantage. You can trade them like stocks. That means you can buy or sell them anytime the market is open. Mutual funds only trade at the end of the trading day. With ETFs, you have more control. You can set price limits, track performance in real time, and make quick changes if needed. For many investors, that flexibility is a big benefit. It gives you the simplicity of an index fund with the convenience of stock trading. 5. Low fees make a massive difference over time. One of the biggest advantages of ETFs and index funds is their cost. Traditional mutual funds might charge fees of 1% or more each year. That may not sound like much, but over 30 or 40 years, it can cost you tens of thousands of dollars in lost growth. Index funds often charge fees as low as 0.03%. That's just $3 a year on a $10,000 investment. Because index funds don't require expensive managers or constant trading, they can keep fees low. And when you invest for decades, every dollar you save on fees stays in your pocket, growing with compound interest. 6. ETFs make it easy to start investing, even with small amounts. Not everyone has thousands of dollars to start investing. That's why ETFs are so useful. Many brokers allow you to buy fractional shares of ETFs, so you can get started with as little as $5 or $10. You don't need to wait until you're rich to invest like you're serious. You can set up automatic deposits, buy a portion of a fund, and build your portfolio slowly. Over time, those small amounts add up. ETFs take away the excuses. They make investing possible for students, young professionals, or anyone just starting out. 7. Index investing supports long-term thinking, not short-term chasing. When you watch the news or scroll through social media, you see a lot of hype. People talking about the latest stock to buy, the next big thing, or the crash that's coming. This noise leads many investors to chase trends, buy high, sell low, and lose money. Index investing is different. It focuses on time, not timing. The goal isn't to get rich quickly. It's to build wealth slowly and steadily. Index investors ignore the noise. They invest every month, stay invested through ups and downs, and let time do the work. That mindset leads to better decisions and better results. 8. ETFs cover more than just the US stock market. Most people start with index funds that track big US companies, like the S&P 500. But ETFs offer much more. You can invest in international markets, small companies, real estate, government bonds, or even specific industries like clean energy or technology. This means you can build a complete portfolio using only ETFs. Want to add stability? Buy a bond ETF. Want growth? Add a tech ETF. Want global exposure? Add an international index fund. With ETFs, you don't need dozens of individual stocks. You can achieve diversification, balance, and strategy with just a few carefully chosen funds. 9. Index funds keep your emotions out of investing. One of the biggest reasons people lose money in the market is emotion. They panic when prices drop. They get greedy when prices rise. They sell at the wrong time. They buy for the wrong reasons. Index funds help protect you from this. When you invest in an index, you're not betting on a single company. You're investing in the entire market. That makes it easier to stay calm during downturns. You trust the system, not the headlines. And when you commit to a plan, like investing monthly into an index fund, you remove emotion and focus on discipline. That's the mindset that builds real wealth. 10. Index funds make wealth building simple and realistic. At the end of the day, index funds are popular because they work. They're simple. They're proven. They don't promise to make you rich overnight, but they give you a realistic way to build wealth over time. You don't need to be a market expert. You don't need to predict the future. You don't need to spend hours researching stocks. You just need to choose a fund, stick with it, and keep investing regularly. Over time, the market grows. Your investments grow, and your future becomes more secure. That's the power of index investing: steady, reliable, and built for everyday people. Index funds and ETFs are changing the way people invest. They give you access to the entire market. They keep costs low. They help you stay focused on the long term. And they make it possible to build wealth with consistency and patience. You don't need a financial degree. You don't need to time the market. You just need to start. Pick a strong ETF. Set up automatic investments. Ignore the noise. Let time and compound interest do their job. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.